Namaste, Chokkalingam Palaniappan from Prakala Wealth Private Limited. Let us understand what is a covered bond. See, we have heard earlier of structured debt or asset-backed securities (ABS) or mortgage-backed securities (MBS). Many of those things. Now those items are being brought to retail investors in the form of covered bonds. These are very popular, usually popular in Europe, where banks convert certain debt securities into a covered bond. But in India of late, some of the institutions have started doing this. They may not be necessarily banks. A financial institution, whatever may an NBFC or a HFC, Housing Finance Company, lends 10 lakhs to 100 customers. So it becomes 10 crores. So now the financial institution needs funds to grow. So they have to keep on selling mortgage loan. However, the market is very tight for them. They are not able to get funding as much as they would like because banks are not giving. Pandemic has come. So the banks are afraid that these NBFCs may not be able to collect money as needed, or there could be large NPAs, all those things. So now these institutions are coming out with an innovative idea saying that okay, this 100 loans of 10 lakhs each will be transferred to a special purpose vehicle, and this special purpose vehicle will be SPV, we call, generally it will be in the form of a trust. So that trust will issue bonds of 100 each, for example, or even 1,000 of 1 lakh each. So it becomes 10 crores. So what this institution is saying is, even if there is a problem for me, even if I go bankrupt, the institution goes bankrupt, the bondholders of this SPV or the trust will not have any issue because the EMI comes directly to the trust account. So these 100, these 1,000 bondholders who have bought rupees 1 lakh each will be serviced directly by the trust. Hence, there is a protection. Even if the institution goes bankrupt, this asset is held separately in an SPV. Hence, there is no issue for these bondholders. Hence, these are called covered bonds. There is a protection. This is what. But now, whether one should buy, a retail investor particularly should buy. Say whenever there is a higher interest rate, it comes with higher risk. Generally, otherwise why, a mutual fund product, a debt product, or a bank FD is giving 5.5%, and someone else is giving twice that, 10.5%, 11%. It means there is some risk involved, which is higher than a bank, which is higher than a mutual fund. Now, the retail investors should understand, in some of the videos, which is circulating regarding these covered bonds, they are saying it is safer than mutual fund, it is safer than bonds. My humble opinion is it is not true. What we have to understand here is mutual funds is a diversified product, means it has diversified risk because they give loan to 50 companies or 100 companies across sectors. Here, these covered bonds, we are giving loan to a single company or a single sector. So obviously it has higher risk. Say let us assume during pandemic period this company goes bankrupt, that is fine. It has the assets are held separately. Now what about those 100 loan borrowers who are not able to pay? Say let us assume 20% is not able to pay. Then automatically the bondholder will get only 80% of the cash flow. The 20% will become an NPA. So this risk is not mitigated. The NPA risk is still there. So conservative investors should be careful before getting into this type of covered bonds. These are not widely popular in India right now, and as I see, to my knowledge, I may be wrong, but to my knowledge there are not very strict regulations, unlike mutual fund, NCDs, many of those are listed, and these bonds carries the highest risk of illiquidity. So illiquidity, Franklin Templeton had an issue because of illiquidity. So illiquid bonds always carries a risk. When everyone starts asking money, there is no one to buy. Automatically the price goes down. There is issue. The company which organizes this covered bond will also be not able to do anything. In even the case of Franklin Templeton, at least people have recovered a majority of the money and still are recovering along with interest and everything. Whereas in case of DHFL, Divan Housing Finance, IL&FS, still people have not yet gotten their money back, and it is doubtful how many percentage they will get of their original principal. So conservative investors should be really careful. Before getting into this, if you are an aggressive investor, you have a lot of money and you want to test the waters, you want to try out many things, then absolutely you are fine. One can go ahead. Otherwise, for conservative investors, it's better to consult their financial advisor or financial consultant, whoever they are dealing with, and then get into this covered bonds. This is my humble opinion. So as I earlier said, these are not new products. These are being brought to retail investors now. When I compare this with other products in mutual fund along the lines of the percentage of return, say like there is a category called balanced advantage fund or dynamic asset allocation funds, which has both equity and debt. They can offer people in the long term 8 to 9% return generally, and they come with much lesser risk than these bonds. So if someone is interested, probably they can look at those type of funds. They can get into conservative hybrid funds to beat the inflation. Yes, they do carry market risk. When market goes down, your investment will go down, but however, when market comes up, automatically things will come up, and taxation will also be friendly, and they are well regulated, widely popular, those kind of products. So or if you are really conservative, people can look at Reserve Bank of India RBI bonds, colloquially called as RBI bonds. So they are all much superior option, without any risk, because they are backed by Government of India. Even your PPF, senior citizen savings schemes, Vaya Vandana Yojana, many of those schemes. Look before you get into these covered bonds. See you in another video. Till then, goodbye.